Let me tell you something that happened this week that most people completely ignored. Three strangers, no shared offices, no group chats, no coordinated research, each sat down independently and ran their own analysis on Bitcoin. One worked with institutional capital flow data. One studied historical market cycles going back decades. One ran pure technical wave structure. They never spoke. They never compared notes. And when all three published within days of each other, every single one landed on the same number, the same price zone, independently, without knowing the others existed. In professional finance, when that happens, people stop talking and start moving, because that is not coincidence. That is the market whispering something it rarely says out loud. But here is the uncomfortable part. While professionals were quietly digesting that convergence, most retail investors were still operating on a completely different belief. That Bitcoin has already found its floor, that institutions have permanently protected the downside, and that patience alone will be rewarded. That belief is not evil. It is just expensive. And before you make your next move in this market, you need to understand what is actually happening beneath the surface. Not the story being told in headlines, but the mechanics running silently underneath them. Start with BlackRock. Not because of anything they said publicly, but because of what they did quietly. This week, they moved over 2,500 Bitcoin, roughly $170 million worth, directly onto Coinbase. In market structure terms, that kind of transfer has one primary meaning. Assets sitting on exchanges are positioned for sale. They are not in cold storage. They are not locked in a long-term custody arrangement. They are liquid, accessible, and ready for distribution. That single movement tells a more honest story about institutional intent than any press release ever could. And it does not stand alone. Since January began, every single US-based Bitcoin ETF combined has seen approximately $4.5 billion walk out the door in net outflows. Not a one-week blip, not a seasonal adjustment. A sustained, directional, multi-week exodus of capital from the very products that retail investors were told represented permanent institutional confidence in Bitcoin. The engine that drove prices from $40,000 to nearly $100,000 was ETF inflow. When that engine runs in reverse, the math does not care about your conviction. Here's what that means personally for millions of investors. Everyone who bought Bitcoin between $60,000 and $97,000 bought into a market that was being artificially elevated by that inflow engine. Not fraudulently, just mechanically. When billions of dollars pour into any asset, price goes up. When those same billions begin leaving, price adjusts downward with the same mechanical logic. The technology did not change. The network did not weaken. The idea did not die. But the immediate supply-demand equation shifted. And markets do not wait for investors to emotionally process that shift before repricing. Now look at the retail side, because this part is even more telling. Coinbase, the largest publicly traded crypto exchange in America, reports how many users are actively trading each month. At the peak of the last bull run, that number exceeded 11 million Americans. Today, that figure has dropped dramatically. Millions of people have not paused. They have left. Robinhood, the platform that introduced an entire generation to crypto trading, reported a steep year-over-year decline in crypto revenue that cannot be explained away as temporary volatility. The users are gone. And critically, they did not stop being interested in speculation. They just moved somewhere else. Prediction markets are now absorbing enormous amounts of the same speculative energy that used to flow into Bitcoin. The appetite for risk is alive. The destination changed. Why does this matter so much? Because Bitcoin's most violent upward price moves, the ones that turned $10,000 into $60,000, the ones that created generational wealth stories, were never driven purely by institutional buying. They required mass retail participation. Millions of ordinary people seeing price move, feeling the fear of missing out and piling in rapidly. That emotional amplification layer is what converts a 20% move into a 200% move. Right now, that layer is absent. Google search data for Bitcoin purchasing intent in the United States sits near multi-year lows. Without retail ignition, even genuine institutional buying produces slow, grinding price appreciation rather than explosive acceleration. The move everyone is waiting for requires a crowd that currently is not watching. For altcoin investors, this is even more serious. Altcoin seasons, those periods where smaller tokens multiply in value while Bitcoin dominance drops, have never been institutional events. They happen when retail investors, already energized by Bitcoin gains, start rotating into riskier assets, chasing higher percentage returns. No institutional ETF manager is rotating from their Bitcoin allocation into mid-cap DeFi tokens. That is a retail behavior driven by retail emotion. And with retail engagement at current levels, the mechanism that creates altcoin seasons is structurally inactive. The macroeconomic picture adds weight to everything above. The Federal Reserve's preferred inflation measure keeps printing above target. That one fact changes the entire interest rate calculus. When rates stay elevated, capital has somewhere else to go. somewhere that offers predictable returns without the volatility of a digital asset in the middle of a correction. For institutions managing other people's money with fiduciary responsibility, the comparison is straightforward. A Bitcoin position down over 20% year to date, or an instrument yielding 5% with near zero volatility. The allocation decision writes itself. Simultaneously, economic growth indicators are showing meaningful deceleration. Economists are using the word stagflation, a condition where inflation stays high while growth weakens. That is historically one of the worst environments for risk assets because the standard policy tools cancel each other out. Cut rates and inflation accelerates. Hold rates and growth deteriorates further. The policy paralysis that results keeps institutional money on the sidelines regardless of long-term optimism about any particular asset class. On the technical side, the levels that held as support during the bull market have now flipped. They sit above current price, functioning as resistance, ceilings that price must fight through rather than floors it bounces off. Every attempted recovery runs into that overhead supply and gets pushed back down. That structural shift does not resolve in days or weeks. It typically requires months of consolidation before genuine directional momentum can rebuild from the ground up. Which brings everything back to that number. $40,000. The level that 3 independent analysts, using capital flow modeling, historical cycle analysis, and long-cycle technical wave theory, each arrived at separately as the logical structural support zone in a continued downside scenario. Not a certainty, not a prediction offered for clicks. A statistically defensible scenario supported by converging professional analysis. The value in knowing this is not panic, the value is preparation. If $40,000 arrived tomorrow, would you know exactly what you would do? Or would you be making that decision for the first time under maximum emotional pressure with no framework in place? Markets destroy wealth most efficiently in the second scenario, but here is where the analysis has to be honest in both directions, because the same market that contains real downside risk also contains conditions that have historically preceded some of Bitcoin's most explosive recoveries. Mining hash rate has jumped 40% in just 25 days. Think about what that actually means. Mining is not a hobby. It is an industrial operation requiring long-term capital commitments, energy contracts, and equipment with multi-year depreciation schedules. Nobody expands a mining operation on a whim. When hash rate surges during a price downturn, the people spending real money on real infrastructure are voting with their balance sheets that Bitcoin's long-term economics remain intact. That vote carries more information than any tweet or YouTube prediction. Strategy, formerly MicroStrategy, purchased 2,486 Bitcoin this week, during a period when the fear and greed index sits near historic lows, during a period when ETFs are bleeding outflows, during a period when most retail investors are either frozen or exiting. A publicly traded company, with board oversight and fiduciary obligation, made one of its largest single purchases in recent memory. That is not impulsive. That is a deliberate, calculated bet made by people who have studied this asset longer and more carefully than most investors alive. Quantitative flow models that track capital movement independently of price action are currently showing Bitcoin trading roughly 40% below what flow dynamics would justify as fair value. A 40% discount to flow-implied fair value has occurred only a handful of times in Bitcoin's history, and each previous occurrence preceded significant price recovery. This does not mean recovery is guaranteed or immediate. It means the structural setup that preceded past recoveries is present right now. The relationship between Bitcoin and gold is sending an equally unusual signal. Gold is at all-time highs. Bitcoin is down over 20% year to date. Historically, these two assets maintain a meaningful correlation. When macro fear drives gold up, the same fear eventually drives capital into Bitcoin as well. The current divergence between them ranks in the bottom 1% of all historical observations. Extreme divergences between correlated assets resolve. The only question is which direction and when. Derivatives positioning creates one more hidden dynamic. Approximately $25 to $30 billion of open short positions currently exists across major Bitcoin exchanges. Every one of those positions is a bet that price continues falling, and every one of those positions becomes forced buying if price moves meaningfully upward. A short squeeze of that magnitude, triggered by the right catalyst at the right moment, would produce upward price acceleration so rapid that most retail participants watching from the sideline would not be able to react before the majority of the move was already complete. This is not a prediction that a short squeeze is coming. It is an explanation of why the current market structure contains a latent mechanism for violent upward movement that the bearish headline narrative makes completely invisible. Regulatory clarity is approaching. The Clarity Act moving through Congress would for the first time establish clean legal definitions distinguishing crypto commodities from crypto securities. Institutional compliance departments have been waiting for exactly this framework before deploying capital at full scale. The billions sitting on the sideline waiting for regulatory green light are not hypothetical. They are documented in public statements from asset managers who have been explicit about what they need before proceeding. When that clarity arrives, the deployment window it creates will not stay open long. So what does a serious investor actually do with all of this? Not panic at the downside scenario, not blindly buy because of the opportunity signals. Build a framework that holds both realities simultaneously and makes decisions based on probability and process rather than whichever emotion is loudest in a given moment. The $40,000 scenario is real and deserves preparation. The accumulation signals, the flow model undervaluation, the short squeeze potential, the regulatory catalyst, these are equally real and deserve recognition. The investors who consistently outperform across full market cycles are not the ones with the best predictions. They are the ones who processed the complete picture honestly, established their response framework in advance, and executed with discipline when others were frozen by uncertainty. Every data point in this analysis is publicly verifiable. ETF flow records, corporate purchase announcements, on-chain hash rate data, macroeconomic releases, institutional research distributed through financial media. Nothing here requires insider access. What separates outcomes in markets is not access to secret information. It is the willingness to integrate available information honestly, understand how emotional extremes create pricing inefficiencies, and act according to a framework rather than a feeling. The market will do what it does. Your response to it, prepared or reactive, framework-driven or emotion-driven, is the only variable you actually control. And in volatile markets, that variable determines everything.